All eyes on the ECB later today as it looks set to cut rates again. Well, trade turmoil created by the Trump administration is likely to see policymakers at the European Central Bank cut interest rates for the 7th time in a year today. Tim Graf is head of macro strategy for EMEA at State Street Global Markets. Tim, are we right to assume another rate cut from the ECB? And is this all to do with tariffs?
No, I don't think it's entirely to do with tariffs. I think probably if, let's say, none of the tariff news had ever happened, the ECB was likely to continue easing a little bit further. I think the tariff story has solidified the intentions to ease a little bit more solidly. And it's also probably brought further easing beyond this meeting onto the table, simply because growth risks to the Eurozone have obviously ramped up as a consequence of tariffs. But growth risks were already relatively high anyway before all of this news. So they were looking to get rates, I think, to or just below neutral anyway. This just locks it in.
So you said that you thought we would still get a rate cut even without the tariff noise, but not as aggressive. So how aggressive do you think the ECB will be for the rest of the year?
I think for the rest of the year, we should probably look for at least 2 more cuts after this meeting. And that's where I really think markets have started to price in that easing due to the trade war consequences. I think prior to that, you could have looked at the situation and thought, well, fiscal policy is expanding in the Eurozone, inflation's maybe starting to bottom out, and they only really need to get rates to neutral or around maybe 2%. But now that you introduce this risk, you have that threat to growth that even fiscal policy expansion might not be able to offset fully. And there, I think it probably does argue for rates to be just below where they see neutral. So say 150, 175 maybe.
You say that you don't think that fiscal expansion might be able to offset the worries over a trade war. But there was a lot of optimism that, especially with Germany and the change in their policy, that it could have overcome anything like a trade war. Why has that changed?
I think uncertainty is probably the key word to use here. It's a word we use in every market environment, but it's especially heightened now simply because the Europeans, nor do any other economy or central group of central banks really understand just how bad this could get at this point. We don't know how much might be negotiated away. We don't know what the final state of trade relationships between the Eurozone and the US will look like. And so I think in that environment, especially given inflation really isn't as problematic as it once was in the Eurozone, you can look for policy settings to be easier than they might otherwise have been, simply because we can quantify the effects of fiscal policy expansion to a degree. But in terms of the hit to growth and the uncertainty created by trade tensions, that's far, far harder to model. So I think it just argues to err on the side of caution and more easing.
Now, we also heard from Fed Chair Jerome Powell on Wednesday. He didn't really seem to hold back on what he really thought about tariffs. What did you make of what he had to say?
I think it's quite right to highlight the tension between the two aspects of the Fed's dual mandate, while also acknowledging that the Fed can step in if there are financial stability concerns. That is also part of their mandate with the gears of the financial system start to grind to a halt. But as he brought out, that has really not been the case. You've seen creaks in the system, but you have not seen breaks in the system that might have brought on non-traditional policy measures that aim to address those financial stability concerns while leaving rates and the balance sheet trajectory basically as they are. So I think it made sense what he said insofar as, again, as with the Europeans, the Fed are an institution that really has to kind of watch and wait and see what happens. Almost in a sense, they are guaranteed to be behind the curve when it comes to policy, but they've been put in that position by an administration that is pursuing policies that seem to change pretty much every day.
So we shouldn't expect a rate cut from the Fed next month then, should we?
I wouldn't think so. I think you won't see action from the Fed until beyond mid-year at the earliest, simply because we won't know the effects of whether sentiment, which has clearly deteriorated, ultimately translates into weaker hard data. In fact, hard data so far have been softer, but they have not necessarily been weak yet. And we saw that with the retail sales data earlier this week. It still shows signs of a US consumer that's holding up pretty well. Now, sentiment on the consumer side has soured very dramatically, but it remains to be seen if that is followed up in hard data for Q2, for Q3. I suspect it will be, but I think the Fed won't be in a position to act on that until early Q3 at the very earliest.
And that was Tim Graf from State Street Global Markets. And don't forget, you can watch more videos on Reuters.com.